Now, before we begin discussing the other balance sheet items, liabilities and equity, let me make a couple points regarding the last video, and especially when it comes to the non-current assets. I already mentioned that non-currents are, categorized into tangible and intangible assets, and tangible assets are, normally grouped into one line, which is gross property, plant and equipment, PP&E, right? And that is the, you can say the purchase amount, which represents the gross property and plant and equipment. And that is the amount that remains the same over the, asset's life. But if you would like to know the details about the original cost and the depreciation expense and everything else, if you would like to know the details of those can be found in what is called the notes to the financial statements, and that is something that is accompanied by the main reports. Alongside the balance sheet, the income statement and cash flow statement, we have something called the notes to the financial statements, and all of those details can be found in here. The other point that I wanted to make before we leave this screen is regarding the intangible assets, and I already mentioned, especially when it comes to goodwill. Goodwill, includes items that are not listed on the balance sheet, such as the brand value, the customer loyalty, the skilled workers and all that, right? And the point is that goodwill, especially, it is reported and recognized only if when a company, let's say, wants to purchase another company and pays more than the fair value of the net assets, right? And by that I mean A minus L. So that's the net asset, because when you purchase another company, you do not only buy their assets, right? You buy their debts and obligations as well, right? So the net asset is something that you're interested in. And when a company wants to purchase another company and pays more than the fair value of the net assets, that additional amount, it is what is called goodwill. And then in that scenario, that is the only way that you recognize and report it on the balance sheet. And this will become more clear for you when we talk about the liabilities in this video, actually. So that's another point. And here we do not have, as you can see, the goodwill probably in our sample. We did not recognize it, but I just wanted to, point that out, that what is the scenario that you recognize that. And also we do not have the amortization here. Probably in terms of the intangible assets, what we are holding are financial assets, like shares of another company that are theoretically unlimited in terms of their expected useful life. And that is the scenario that when it comes to tangible or intangible. That's the only scenario that we do not depreciate or amortize, if you can recall from the last video, right? Okay, I think that's clear enough. Let's move on to the liabilities. Okay, now liabilities and owner's equity. Now, when we were talking about assets, we were discussing actually what the company owns, right? Now here, we would like to find out how those assets were financed. And we already know that they can be financed through this section, which is liabilities, and that's basically debts, right? Or owner's equity, meaning that the assets were financed with the owner's money, right? Now let's talk about the liabilities first. And liabilities, just like assets, are also categorized into current and non-current. And we know the difference is just the length of time, right? And when we're talking about current liabilities, we are talking about those that are within a year, right? Or the current operating cycle. And the non-currents are just long-term, right? So let's talk about current liabilities first. And the first line is account payable. Account payable is credit extended by suppliers or short-term borrowing. Now, if you can recall, when we were talking about assets, we had an item called account receivable, right? And that was when you sell something on credit. Well, this is the opposite, right? That is when you buy something on credit from a supplier. So you go to a supplier and you make a deal, you buy the items that you need, and you tell them that you'll pay them at a later date, right? So that is your obligation. That is account payable. That is something that you have to pay, within a year. Or it could be, short-term borrowing. You can do the same. You can go to a bank and get a short-term loan, right? So that is also is categorized in terms of the account payable. Okay, the next line is accrued liability. Accrued liabilities are unpaid operating expenses. All right, so whatever is related to operation, that is unpaid operating expenses, are accrued liabilities, and the most famous example of it is the money due to workers but not yet paid. So when we were talking about accrued liabilities, this could be accrued wages, accrued, compensation. All of these are accrued liabilities, and they're all related to your operating expenses, right? So that should go here. And again, because it is, normally due within a year. That's why it's current. The next line is current portion of long-term debt. Now we know that we have a long-term debt here, right? So this is the current portion. So this is the portion of the long-term debt that is due within the reporting period, whatever the reporting period is. So you have a long-term debt, the amount that is due within the reporting period, it goes in here, the current portion of the long-term debt, right? I think that's clear enough. And when we pay these, the whatever amount that we pay in this section will be deducted from the long-term debt, right? Now, when it comes to other, liabilities, just like, other assets, I try to actually put the most important ones, and it is very rare, like I said, that you look for a company's balance sheet and you do not see at least these items in there. But, depending on the nature of the company, you might see more or less lines. But these are the ones that you should know. Now, if I were to give an example in terms of the other things that you could, see in terms of current liabilities, if you can recall over there in terms of the assets, we had something called prepaid, let's say prepaid taxes, right? Because the tax was not due and you were paying in advance, and that amount is still part of your assets, right? Here is the opposite. So it could be, deferred tax, right? So deferred tax could be, part of your, the other current liabilities that I can give you as an example. Or any unearned revenue, let's say, that could be also categorized as current liabilities. Okay, let's move on to the non-current liabilities. And here we most likely have a long-term debt, which is long-term debt is money borrowed from banks or other lenders that is to be repaid over periods greater than 1 year. So you have a long-term debt. The name itself is, I think, pretty, self-explanatory, right? So that is in terms of your non-current and current. And, non-current liabilities, I said that long-term debt, but it could be, another famous example of it is, mortgage payments, right? Because mortgages are in nature, long-term, right? 20, 30, 50 years. So mortgage payments also could be part of the non-current liabilities, and I just wanted to point that out as well. All right, let's move on to the owner's equity. Now, owner's equity is the other way of financing the assets. And it is sometimes called shareholders' equity, and it's important for you to know what do we mean by shareholders. Now, shareholders are the residual, this is the key point, residual owners of the company. Residual means that, after all the debt has been paid off, right? So whatever is left, that's what's yours, right? Because you're the owner. Now, like I said, owner's equity is also another form of another way that we can finance the assets, and that can happen in two ways. That's why we have two main sections when it comes to owner's equity. The first one is common stock. The second one is the accumulated retained earning. Now, when it comes to common stock is the amount received from selling stock to common shareholders, which are direct contributions by owners, right? So that's one way that we can, finance the assets through the, selling the common stock to shareholders, right? So when the shareholders buy those common stocks from you, they become part owners of the company, right? That's why the amount that they give you, or the amount that you received from selling the stock to common shareholders, those are the direct contributions by owners, right? So that's one way. Now, the second way is through the accumulated retained earnings. Retained earnings represents the company's undistributed income. I will explain what it means. Undistributed income. Retained earnings are an indirect contribution by owners who allow the company to retain profits. Now, when I say retained earnings represent the company's undistributed income, because the income that the company generates can be also distributed, right, through what is called dividends. I'll write it here. Dividends, right? If a company gives out dividends, that is a form of distributing those incomes, right? But when you do not distribute those incomes through paying dividends, that is the retained earnings, right? Because at the end of the day, the companies are there to generate profit, right? And sometimes they distribute those profits amongst themselves through dividends, so all the shareholders get a piece of that profit. And sometimes they decide to retain those earnings, right? So to let the company run, and make more profit in the future. So those retained earnings that the shareholders allow to retain, those profits that the shareholders allow to retain, that is called the retained earning. That's why it is called the indirect contributions by the owners, right? Because the company is making the money, the shareholders are only allowing some of the profit to remain within the company, so it can be helpful in terms of generating profit in the future, right? And the retained earning line is, you can say, directly related to the income statement, and which we will see soon. And, you will see this accumulated return earning go up if the, company actually is making profits, right? Making the net income, which is, comes directly to as the retained earnings. So these lines, the net income and the retained earning, are very much related. So if the company makes enough money, make a net income, make a profit, the retained earning goes up, and vice versa. If the company starts losing money, you will see that the retained earnings also go down, right? But like I said before, all of these financial statements that we were talking about, they are only a piece of the puzzle. So you will get the full picture once we have talked about all the three main statements. And once we have talked about especially the income statements, then you will find out all the relationships and the links between the the statements a lot better, and it'll make a lot more sense. All right. So that's your balance sheet. In the next video, we will talk about income statement. See you in the next video.